but we're going to wrap.
Money in the bank.
Rates are good. Pretty exciting.
You know why? Why?
Free money. You understand what I'm saying?
Hey, welcome back to the program. This is your Real Estate Chalk Talk, the money segment of the program. 651-231-2500. That's Kelvin's number, 651-231-2500. I love that intro, by the way. I still
like it. And it's true again, right?
I know
Rates
it.
are all the way back down.
Yeah.
Had a great week.
Yeah.
Economic data's coming in because we measure year over year, and it was high a year ago, and it's high now. So now it seems like it's okay.
Yeah, if you compare it to 2 years ago, it's
right.
crippling.
Then it's awful,
yeah.
right? But we did see some of that, and we did see some really nice improvement over the past week in interest rates. We dropped 100 basis points literally in rate, which is great. So
That's
we're down.
Really good.
We're down in mid sixes now.
That's
good. We were mid sevens. Now we're mid sixes. So, we just want to settle in, but I don't think we're going to settle in.
What do you
soon.
What do you think, really? I mean, I think that if it stayed at mid sixes, it could stay there for years. And people get accustomed to it.
Mm-hmm.
I was having a conversation just the other day with someone. We were talking about new people coming onto the market, and the kids coming out of college and stuff like that. And right now they're focused on school. They're not thinking about any of this stuff. They're just trying to get through school, to get out. And now they're going to buy a house. How much is interest rate? 6%. Oh, okay. And they qualify. Yep. It's only the ones who lived through 3.5%.
Yep.
And maybe said, I'm going to wait for prices to come down. We've heard those ones.
Yeah. Oh, how many people missed an opportunity because they said home prices were too high?
Yeah, I'm going to wait for them to come down.
Yeah, because what's happened is home prices have
stabilized,
kind of stalled, or a little bit, but rates went up.
Yeah.
So now you're.
Yep, and home prices are going to stabilize and go, or they've kind of gone sideways, which they normally do at this time of the year anyhow.
Yep. I don't believe, though, next year we're going to see a big bump in appreciation.
You're going to see a normal appreciation bump.
1%,
maybe
2%,
1%, maybe 2%.
Maybe.
But the point is they aren't going
But you
down.
ran this sucker up for the last 3-4 years in your industry.
Right.
So now we're
going to lock in that gain.
I know, right? So don't you like it how I blame you for anything? Like, you guys really did this to us,
Yep.
Let's talk about how things are looking. They're looking better, but there's an impact. We were talking this morning at coffee, Keith, just the impact of just a conversation I had with a past client who was looking to downsize potentially, and we were running numbers. I'm a nerd on this stuff, so we're just sitting there. I'm on my headset. And I'm just like boom, boom, boom. And it's like what we realize is that they're probably in a home. They have a mortgage right now of probably $400,000, $450,000, $500,000, say $500,000. And going, okay, if we got some equity out, we did this, we paid it down, and boy, are we even making headway on saving money on that payment? So I started doing some analysis and realizing that, you know what, they would have to buy a significantly smaller home to do anything, and not where they want to go, you know. So we looked at, because their rate, and I'm just going to use rough numbers, but 7-8 months ago, we were at 3.75. Today, we're at 6.75. So what did we lose in that purchasing power? And I just said, okay, what if, and I just took a first-time home buyer, like $80,000 of income. Let's just kind of run the numbers just for our sake and see what that difference is. Well, all things being equal, at 3.75 on that rate, they qualified for 389.7. So say 390, right? At 6.75, it's 290. So it's $100,000 swing in purchase price. Well, for $100,000, that's a very, very different home.
That's a major difference,
right? Very different home, same payment, same payment. So then we started looking and say, okay, well, what if rates go to 5.75 or 4.75? And basically, a rule of thumb is it's about $35,000 in purchasing power per 1% in that rate.
Okay.
So if so we're losing. So if we're at 6.75 and we go to 5.75, we're going to pick up about $35,000 in purchasing power. So 200
people
to
just to get a visual on that, at $35,000, that 1% change, you gave up your finished lower level. That's about what it costs you.
Really?
A finished lower level.
That's a great picture.
Or your $35,000, your 1% interest rate, you gave up your 3-season porch. Right, because that's about what a 3-season porch is going to cost you. Or that big deck that you wanted.
Yeah,
You know,
love the
that
deck.
great big deck that you
Yeah.
love, that maintenance free with the steps going down.
Yeah.
That's what you lost
Hmm.
with that 1% interest rate gain.
Interesting. So if we, so as we're looking, we're just saying, okay, can rates get back down to the, high fours, low fives?
Mm-hmm.
We think it will, but we think it's going to be mid 23 Q2.
And what's going to cause that?
Just the year-over-year inflation numbers, and we're going to be.
I mean,
we're
a
gonna,
mental thing, because it isn't.
Because
Because prices are still high. I mean, people are
prices-
still paying 30% more for a gallon of milk than they did 2 years
Yeah,
ago.
what will happen is we'll run headstrong now into a recession,
Mhm.
right? Because we're seeing it already. We're
Right.
seeing these large companies start to lay off
Amazon
people.
just now 10,000 people.
Yep. I mean, look at loanDepot. I mean, loanDepot is in the news all the time. That's the company that we're with, but they're in the news way too much. But we're a publicly traded company, and we're right sizing. When you have a consumer direct deal that's down 80%, you get rid of people.
Yeah.
Boy, do we take heat on that. I can't tell you.
Right.
It's a whole different conversation. But these larger companies are laying people off. So we're going to be in a recession. Then the Federal Reserve is going to say, we got you, and they're going to start taking that Fed funds rate back down.
Mm-hmm.
Right? We're going to see them jump it one more time in December. December 12th, I think, is the next meeting. They'll move it up about 50 basis points, maybe 75. So now we're going to be pretty high. So now when we're into a recession, they'll start to knock that down.
So
rates will come.
explain to me the logic then. It could, because they've raised the rates and
To
caused
slow down inflation, because they want to slow down everything. They want everything to slow down
and
Is that-
cause a recession.
Yep.
Then they're going to turn around and lower the rates.
to help stimulate the economy again.
And
Because
Won't
hyperinflation.
that just bring it all back?
Well,
again?
that's
I mean, it's just,
yeah, but that's the economic cycle, right? I mean, this is the cycle we go through, because you either have hyperinflation or recession, and they would rather have recession than hyperinflation, which is, if you have to pick a road, you pick recession.
So
right?
what Reagan said with supply side economics was the classic definition of inflation is too many dollars chasing too few goods.
Yep.
So Reagan's philosophy with supply side economics was, well, you can either reduce the number of dollars,
Mhm.
which causes a recession, or you can just make more goods.
Mm-hmm. But then you also have an administration in place right now that is reducing goods, right? That's
Yeah.
reducing gas and energy independence and all the. I mean, we can go down this whole list, but that's the cycle of our.
And I've spoken
Economy
with
a
a
little
number
bit,
of economists
you know.
about that, and they all point back to its gas prices.
Mm-hmm.
You know, it's it's energy costs.
It's energy at the end of the day,
Yeah.
because it flows into so much. So anyway, so I just wanted to have that conversation so we get a little bit of a perspective on what is this doing. Now, the other conversation we had this morning, we should just record our coffee
I know
and
it.
play it and then just be done.
And be
But-
done. So good.
but so good. But one of the things that we talked about also is, a year ago, let's use a $300,000 home. You were
Mhm.
going to bid that $300,000 home up to $325,000.
Right.
Now that $300,000 home you might get for $300, maybe $285,000.
Maybe, yeah. Good.
And get some closing costs.
Yeah.
So now suddenly we're down here. Instead of up here, we get inspection. We get some of these things. The rate's higher, but here it was lower. And you start to look and you kind of go, we're pretty close. We're pretty darn close. So, and everybody in our industry makes these charts to make it look
Sure.
like, hey, it's okay. But
Yeah.
at the end of the day, interest rates are higher.
Yep.
Payments are a little bit higher, but we're in a little bit better environment to purchase a property than we've been in the past.
Especially when you consider how people tend to run their personal finances. They're doing, most of the time, they do it on how much a month
Mm-hmm.
is it going to cost me to live in this dwelling.
Yep.
And the price I paid for it, as weighs against the interest rate, it really doesn't matter to them too much. And
Mhm.
as rates go up, prices come down, because people only have so many dollars a month to spend on housing.
Mhm.
And the prices will adjust to match that,
Yeah.
or there's not going to be a sale. I mean, that's just the reality of it. There you go back to the supply and demand of housing as it is. So your point is exactly right.
Yep. So let me hit on where kind of rates are. So think of 30-year fixed rates, kind of the traditional where rates, kind of think mid-sixes, right? Because I can't say a specific without blah,
Right.
blah, blah. Mid-sixes. But I will say that we do have some ARM products that we're using that were also mid-fives now,
Mm-hmm.
right? And we can use that product for second homes. Little bump up in rate, but second homes, investment property. So we have some things that's going to be on a 7-year ARM, a 5-year ARM. We're going to do that. We've been using a lot of the 2-1 buy down, which is basically, if we're starting at 6.5, the first year's at 4.5, 5.5, 6.5. So everybody calls it something. They call it inflation busters, this, that,
Yeah.
but this is what it is. And the reality is just give us a call so we can have the conversation, say, hey, do we want to start here? Do we want to start there? I sent out a thing to my just my real estate partner saying, hey, now you got to look at what's that cost between lenders for that buy down, and our cost for that's, it costs about 2.25%. So if you're getting 3% seller pays, we have some to go to closing costs, some to get that rate down, and we're in pretty nice shape. We're in really nice shape. So we're okay. We're hoping rates get in the fives. That'd be nice if we could just be in the fives.
599999999.
So good. So good, right? And we can just live there. So give me a call, 651-231-2500. Again, 651-231-2500.
Just think, we could have talked for. I could talk for another whole segment. Isn't that
I know.
something?
I know.
All right, this is your Real Estate Chalk Talk. 612-627-8000. Give us a call, 612-627-8000. We'd love to help you and just have a conversation with you about your real estate needs, and that call is all with no cost and absolutely no obligation. We will see you next week.
You've been listening to your Real Estate